Welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focused Compounding, sitting next to Geoff Gannon. Geoff, how goes it?
It goes very well, Andrew. Very well.
Glad to hear that. We hope it's going well for everybody else as well. If this is the first time you are tuning in, hit that subscribe button. Follow me on Twitter at Focused Compound. Go to focuscompounding.com. Geoff actually uploaded a investment write-up yesterday. And to get access to that, you could go to Focus Compounding, the company Kingstone Companies, a homeowners insurance company focused on selling through agents in downstate New York.
It's a riveting title.
Yeah, and you just added another one. I was like, yeah, he's. I asked you in the last podcast where you've been spending a lot of your time, and I'm like, yeah, he really is spending a lot of time on financials.
Every other planned write-up is some sort of financial right now.
Really?
I'm alternating it. Yeah, when I did the newsletter that I did, the Avid Hog and Singular Diligence, when I did that, I had a policy of always alternating because we had some people who wouldn't buy banks no matter what, and I had a lot of bank write-ups. So I had to alternate month to month so they wouldn't feel like they're getting ripped off with their subscription and stuff, because, it would come in the mail if it was one after another. The PDF would come in, and if it was like one bank after another, they'd be like, this isn't the newsletter for me.
Yeah,
so you have
like
to switch them off.
Banking one, right?
Yeah, switch them off. So yes, I have planned for a while that probably every other one you're going to see or something like that will probably be a financial, because I've got a much longer list of financials than I have non-financials right now. Mm-hmm. Yeah.
Got it. Cool. Well, if that's is that a market call? What is that? Just shows you where we are in the market with interest rates.
I run screens and look for certain things and read certain lists of all sorts of companies. We focus on smaller companies, so there are more small financials. Probably, there's small banks especially, but small insurers too, that are interesting that way. One industry you have highlighted there, Investors Title Company. I'm going to be doing like a bunch of different title insurers over a while because they are similar, and it would be interesting to look at them each that way.
It's funny, whenever I run the screen, there's a thing on there that tells me when the last time you ran the screen. Yeah. So do you notice when I last ran the screen
No, I
too?
don't look at that.
So I noticed, I'm like, oh, Geoff ran the screen yesterday or 2 days ago or whatever.
Yeah, I actually designed the screen to divide up things between financials and non-financials for something, because the screen was returning almost all financials. And it was probably 50% banks, small banks, and things like that. But that's mostly because of the size or the overlooked part of what we do. That tends to turn up a lot of smaller banks and things, because there's like thousands, or there were at one point. Whereas, that's not as common in other industries. That some of the bigger, more successful things are better known and not as overlooked and stuff. So there's more purely regional things. Yeah.
Got it. Cool. So in today's podcast, we're going to be talking about a topic that I think is going to help out a lot of people. One that I think is pretty interesting, and it's really this act of asking the right questions. Okay. And I think people underestimate the skill of asking questions. And if you want to, find out better quality information, you should really think about, the quality of the questions that you're asking. And to relate this to investing, we're going to talk a little bit about it in relation to management. We could talk about, management, the board, stuff like that. But in every single investment, I would say that there's, few key variables or factors that really matter to the investment case, right? If you could distill it down to that. And it's really, understanding and thinking through different ways, just to learn about the business and stuff, and, learn about management. So we're going to go through and talk, about how we typically do that, because especially in microcap land, I would say the management you invest with is probably one of the most important factors in microcaps.
Yes.
The business, of course, industry, of course. But if there's a close third, it would certainly, if not higher, I would say the importance of it is right there, is the quality of the management team that you're investing with and their view towards, costs, capital allocation, their industry, their business, stuff like that.
Yes, because they can have more influence on a smaller organization, certainly. And also, I'd say the combination of owner-operator may happen more often with these very small companies. You're less likely to have, professional management with a strong board and stuff like that. And also, to some extent, we focus on really overlooked stuff. You tend to have less going private, going public again, going private, those sorts of things. So you're more likely to get a stock that your return comes over time from being in the stock as a public company and not from some sort of extraordinary transaction or something like that. So that makes management more important, if you're getting your return from the business results over a period of years. Yeah.
What do you think is the average tenure of a CEO of a large company?
5 years.
Yeah, I think it's like 4.5, 5 years.
Okay.
I wonder what it would be in microcaps. I'd imagine probably longer.
I mean, it depends on what microcaps you're talking about. Some of them don't.
Because if not, then the company probably just
the
failed.
entire company doesn't stay. I mean, if we look at like you were listed on OTC and you're not anymore, that sort of thing, the amount of time, the churn is very high. Mm-hmm. Yeah. So entire companies and stuff might fail a lot of times, or fail. They were, they're no longer traded actively and stuff because something happened.
Mm-hmm. So a lot of questions that I get, and we're part of all these different message boards and stuff like that too. It's always like, how do you approach management and ask them certain questions? It's like if you're doing the research, you generally understand the business, the products, the economics of everything, right? So when you're going to speak with management, I mean, what are you typically trying to get out of them? I mean, are there any sort of questions and things that you, want to ask them? Is it really just how they think about their business? Is it really, capital allocation? I mean, what sort of questions are you trying to get out of them when you're having these conversations with them?
Well, like what kind of person they are, first of all. How do they think about their business? And how do they think about their future there? Things like that actually are some of the biggest ones, because it's not going to be very important to me if they're going to be gone soon. So, if I think they're going to be there for a really long time or not, is one of them. And then, their sort of motivations, I think, are probably the most important. What they think they're doing and why they think they're doing it. How they would sort of measure success or not, things like that. But those aren't questions I would ask directly of them. That's something that should come out in terms of, as they talk about stuff.
So of that, I mean, what do you think are successful traits of successful managers?
So based on the investing that I've done and trying to look at like what was successful, it's weird. Second career, very likely to be successful. So this isn't the first time that you've done this, or you just chose to start to buy up a company or to start a company or something like that. That has tended to be very successful. So that's one of them, I would say. Founder-led things sometimes. It depends. There's cases where I'd say it's like a refounder. I think they both sort of work the same way. So, those are the big ones that I found.
I wonder how much of that is almost like a pre-selection, right? So you're looking at the manager and they've been successful in the past. So it's easy to analyze and judge them based on what they have done in the past.
Well, actually, it's usually someone coming from something not quite the same.
Interesting.
Okay, so if you if you're exactly in the industry and you came up through the industry, that can be a problem because you don't know all the stupid things that everyone just keeps doing because it's the received wisdom of that's what you do. Mm-hmm. But I see if you ran a business or were at the very high levels of a business or invested in things that were a little adjacent to it, then when you come into that specific situation, you're going to apply those ideas you learned from somewhere else to it. And that's where I really see a lot of success. Yeah, which you wouldn't think would be the case. People will always say, like, I want someone with experience in that industry or whatever. And sometimes it's adjacent industries. But that's usually what people say, that we need someone who is an expert in that sort of thing. If you read write-ups of Value Investors Club or whatever, that's always what they want, is to poach someone from another company that was in the exact same business, and then they come in and they do things that turn stuff around. But actually what I found is people who are just pretty good business people going into a specific industry and taking a sort of somewhat different approach than others did.
I mean, it's like Hunter Harrison with railroads, right?
Well, so that's interesting because he was completely railroads. That's all that he did.
Yeah.
And from a very low level in them on up. But taking the same idea and applying it to railroad after railroad. Now, I think the reason for why that was possible, and we've talked a little bit about this, is I think there's certain industries where ideas don't travel that well between them, the different companies in them, because see, if that was retail and he had applied those ideas, every retailer would copy him because they'd have to just stay in business. But railroads are pretty well protected, so they just made less money than the railroads that applied a lot of his ideas. But that happened before, like 100 years before the H. Harriman. So if you're making some money, you're not going broke, you're paying your bills on time, then you would just say, well, it works for that railroad, but not for us. Whereas like in things like retail and stuff like that, they would steal your customers away. But in the modern railroading industry, it's pretty hard for people to take your customers.
It's like restaurants, for example. Anyone could go eat at your restaurant. Anyone can go see what you're pricing it at. Anyone could go see what you're serving.
And copy those ideas. And I also think there's a strong incentive for them too, because it's pretty easy for a restaurant or retailer or something to start failing if you move in and start taking their business. But I've said before with certain banks, insurance things and stuff, I do think that sometimes there's a better way to do things and it doesn't get transmitted through the industry as well. Because you'd kind of do okay doing what you're doing. And there's big ways that you can improve, but you're making money every year.
Mm-hmm. What are your thoughts on managers learning about investing? I feel like the best type of managers I come across, and of course you have to weed out the certain buzzwords and the Buffett, tone that they like to present and stuff like that. But I'm kind of curious to hear your thoughts on that. I mean, Buffett has always said he's a better businessman because he's an investor, and a better investor because he's a businessman. Yeah, I would think that's true for many people. And I, generally speaking, when I speak or, speak to managers or, read transcripts, I do like to hear just the way that they think about it. And if they think about their business, very similar to the way that we would think about their business. Yeah.
So at the very top, that can be good, right? To think about it like an investor. So I think you have that owner mindset. However, they then need to have people to do their dirty work who have the personality that matches with what they'll be doing. And Buffett's very good at that, getting other people to do things that he would never do. So the person who can be the right person to do that could be very different. When Geico was on the brink, Buffett is not the one who turned it around, and he himself could never have done that because he doesn't have the personality type that would have been needed. Now, once Geico was back on its feet and successful, then Buffett would have been a fine CEO of Geico. But the person needed to have that kind of turnaround it would not be someone like him.
It was like the whole thing with Salman. He came in there as interim CEO.
Yep.
And it was when Salman was very publicly going through, issues. And he came in as almost like the white knight to try to put like a happy face on the company or try to change things. And if he didn't come in, who knows what would have happened to the company.
Yeah, that brings up something because of the Solomon thing. He always talks about the speed with which people tell him bad news and stuff. That's probably the biggest concern that I have when talking to people at a company, management or whatever. If they're listening to this, they can figure it out what thing to make sure there's a red flag, not to tell me. Moving slowly on something that they know to be a problem. So just in business generally, in all sorts of things besides business, people often know that something is a problem and they move far too slowly on it. They often say that they think it might get better and stuff like that and kind of trick themselves into that without moving on that problem and moving very quickly. Buffett talks about inertia. Even in very small organizations, that is the thing that I see the most is inertia on those sorts of things.
But where's the fine line between having a long-term mindset and not succumbing to inertia?
Well, that's fine having a long-term mindset. I mean, I think Amazon has a long-term mindset. Or
thinking for the long-term, judging over the long-term.
Oh, I see what you mean. Us judging over the long term and not thinking about the short term results.
Yeah, but also not eating your own cooking, where the way you're kind of drinking the Kool-Aid and not acting rationally. Is it like really come from, not moving away from disconfirming evidence? I mean, what are your thoughts towards that?
Oh yeah, no. When I mean the inertia thing, I mean like sometimes I think I can hear in their voice or whatever you want to put it that how they describe a business unit or something means that the head of that unit won't be there next year, but they haven't gotten rid of them yet. And probably they know in some part of them that they should get rid of them and they haven't done it yet. That may be the same for exiting certain kinds of businesses and stuff like that. I mean, you can carefully consider whether you want to do something or not, take a different path on it. But a lot of companies do things slower than they need to be done. Very slow on a lot of stuff. I mean, Buffett was speaking specifically about legal sorts of things, which they need to move very fast on, but just problems in general. Problems come very slowly. Now I've miscalculated on some of those things. I've mentioned before I didn't invest in a bank because everything I was good about it. I liked it, except for I thought they were moving too slowly to recognize some losses. And of course, they may have been doing that. They internally were taking it very seriously, but not and putting on a more optimistic face to shareholders and stuff, and they worked through it. But if the same exact company had very quickly taken some losses and stuff, and or built reserves, and in the case of some insurance companies and things that I see, then I might invest with them. I would have in that case. It was purely that you're concerned. Buffett says about there's never just one cockroach in the kitchen. That if you think they should be doing something faster to recognize some past mistakes and they're not, that is a little bit more of an issue. So sometimes, like with an insurance thing or something, if someone's talking to me about it and their thinking might be, okay, well, how much do you think this adverse claim development will be? And let's try to just throw out some numbers and think about it and adjust my valuation that way. That might be the way they're talking. But to me, it's more of, okay, well, what does this go to in terms of management in the organization and stuff that we have this versus some other insurers that were in the exact same position and don't have that kind of reserve development. And what does that mean about other stuff in the organization over time and those things? And so with a very simple company, maybe that might not be a problem. But with a more complex company, there's lots of things they know about the company that I don't and can't possibly predict. And I would worry that they're too slow to act on a lot of negative news that way. I'm just worried that people in the organization aren't bringing bad news up the chain fast enough. Yeah.
What are your thoughts towards boards and judging the quality of boards, just the, who's on the board, their incentives, stuff like that?
The opposite of a lot of people, probably.
Okay, so
I hate to see boards that are all independent directors that there was a company I was looking at. I'm definitely not gonna say what it is and stuff because this person's probably a lovely person who just joined the board, but they checked every single box of what I don't want to see. Right.
Okay.
So they were added to it because the board wanted to add ESG stuff. So they added this person who has background in those sorts of things. Right. Okay. Then they also went to the right schools.
Yeah.
Right. Okay. For that. And then they also had, whatever it was, the right charity things and those sorts of things. It also added.
So the pedigree's there, basically.
Yeah. And
it's
also
like the beauty contest, but for the board.
Right. And also may have added some diversity in things like the age and being outside the industry in that way. But this is someone who we'll see, but everything about it suggests they may not be a strong voice on the board because they're being added to fill in one particular issue that they have that way. My preference would be for someone who is honestly someone who's rich, because that way they're not counting on being paid for high director fees. And
I was going to say, did this person or this individual, are they earning director fees?
They seem like a professional director right now.
Got it. So they sit on a bunch of boards, and
they were former consultant, former. They sit on a bunch of boards now. I'm sure they work to get named to those boards and things.
I get the soapbox out for this because I always talk about this, how through the 1800s, Carnegie, Rockefeller, JP Morgan,
right,
sort of this era, the boards are much more owned by owners of the company, right?
Right. And some bad things happened to the outside investors. Yeah. Sometimes. Yeah. It depends on who it was. If you had an honorable person in that kind of position, then that didn't happen. But it very much depended on the personalities of the people involved, and you had to know whether these were trustworthy people or not.
Yeah. But they also had enormous skin in the game, is what I'm saying.
Yes.
And as the democratization of investing in 1900s and certainly into 2020s or whatever, past whatever you want to call it, the boards have just become much more professionally managed, where you have people that sit on a bunch of boards, they earn their director fees. It's like, how ingrained are they actually in the business? I don't know. How much are they just a puppet there for whoever? And they're just professional board sitters. And I don't necessarily know if that's right for the shareholders, quite frankly. I don't know if that's right for the company. I don't know. I do know that I don't like it. And it's become much more of a thing. Yeah.
And so that's sort of a problem that I would agree with those sorts of things that I see. Also, someone who's there to add, whether it's some reputation or some sorts of things like that. We've talked about frauds and things like that. There's certain people that you name to boards and things to give sort of the halo effect of them being on your board, sort of as a good housekeeping seal sort of thing.
I just hate when people, companies, whatever, they do things for the wrong reasons. So inviting certain people on your board, for example, because it checks all these boxes that actually don't have to deal with, driving shareholder value.
Right, and there's lots of people who could have checked a lot of those boxes that they didn't want. I mean, that's the other thing. Again, in this example that I'm giving, you can also tell that they picked someone who is they'll be able to get along with, but who on paper seems to check all these boxes, right? They didn't actually pick someone who's going to be a real problem for them from an ESG approach when they're not very good on that. Which is usually the case because they're naming who the directors are, and they're going to be people who are people that they can get along with that check those boxes generally. Yeah. It's not a huge deal sometimes, but occasionally it is a big deal. You've read Disney War. I was just reading a book about Tycho recently and stuff. There's some very weak directors in some cases on those, and it becomes a bigger issue on some of the committees that they're on and stuff like that, and things that the company is dealing with, certain transactions and compensation things and stuff. But in general, in terms of like say executive compensation or stuff, you really have to be protected or not from excessive compensation by the thinking of the CEO, not by the thinking of the board. If the CEO sticks around long enough, he's going to get the board he wants, and they're going to give him the money he wants. But if he has a certain sense of stewardship or whatever, or at least some amount of shame or something, then he's only going to take so much money. Those sorts of things. Yeah.
So how would you judge the board then? Really, is it just their history, the type of fees they're taking? I mean, are they even taking director fees? Are they already rich, like you said? Is it like, why are they there? I mean, how would you typically think about that?
Sure. So there's a couple of different things that you see sometimes, right? So sometimes you can have a chairman who's the former CEO. You can have a chairman who's a huge shareholder or something like that. People who are from a founding family, things like that are special situations that way. You can also have the worst ones I've ever seen are very strong chairmen and a very proactive sort of chairman thing. Very rare in the United States, much more common in the UK. Run across it a couple times, didn't like the situation.
But the chairman is involved in like the actual business operations?
Yes.
Doesn't let
disagreement
the CEO...
between the chairman and the CEO on strategy stuff led to sales of things that probably didn't need to be sold, or the chairman leaving, or the CEO leaving, or whatever. Yeah. It's because you have two people that are both trying to decide what to do that way. And sometimes, and those are the most, dysfunctional, whatever you want to say, things.
What do you think the role of the chairman is then?
Depends on the company. I mean, the role of the board and stuff, it depends on the company. Even when I do these write-ups of stuff, I'll sometimes mention people that I consider to be key in some way. But I'm not going to mention every director. Sometimes I'll mention someone that I think this is like probably the most important director who isn't a member of the inside group on this or something. But obviously people who are investors from early on, people who are connected to the CEO or chairman or whoever could be important, people in controlling groups, stuff like that. And then you try to get a sense of it. But it's usually not formal relationships that are the reason for how strong someone is on something like that. And then of course there's issues about certain things make it difficult to have the boards that you would want just because of how demanding it is in terms of time and risk to reputation, all that kind of thing. So certain parts of the board would be different than other parts. You've seen that banks are often have two separate groups inside the board, and one group is going to be a lot easier to find people to do because it's a lot less work. Your audit committee is going to be a lot harder to find people to be on that than is going to be the board generally. So things like that. And that's a lot of that since Sarbanes-Oxley.
How do you think Buffett thinks about, the structure of the board?
Hates serving on boards.
Yep.
Doesn't feel that he did a good job probably on boards or did much of anything.
I mean, and why is that? Do you think he just thought it was more of a...
Because you're usually more effective by not being on the board and having influence with people. Think about it. He wasn't on Tom Murphy's board, and probably Tom Murphy got a lot more use out of having Buffett not on his board than on his board for a long time. Before the Cap Cities deal and stuff, he was on Washington Post, so he couldn't be on Murphy's board. But I think that's true.
I mean, I think he wanted to be on K. Graham's board.
Yes, well,
he didn't come out and say it, but
he owned whatever 10% of the company. She didn't put him on the board, and she was of course.
But what do you think his motive was to that, which is to really help Kay and influence in there?
Sure, and that was the biggest influence that he had there, and was very effective. But I think in a lot of ways, you could be more effective by not being on the board and having a good relationship with someone than having an official capacity of that sort of thing. Sure, and we don't know a lot about that sometimes. And there's been some situations where I've seen things where, the fact that the board wasn't very strong in some ways was helpful because you had someone who was really effective, who was able to basically do more in terms of guiding things for the company than they otherwise would have just by how much stock they owned and stuff. And, there's some situations where I've seen that.
Well, it's kind of like with GameStop right now. Ryan Cohen, the founder of Chewy, he is now the chairman of the board of GameStop, I believe.
Yeah, so you also have things where...
And there's a lot of people like, how the heck did that happen?
Well...
When you bought a massive stake in the company.
No, boards are interesting. So boards normally seem to work much like I've said on the, given the quote about the currency devaluation thing, we're not going to devalue the currency, and then in the middle of the night, you announce devalue the currency. Yeah. Usually people talk about these dissidents on the board and stuff. That's not usually how it works. It's more like, someone in parliament or something forming a government. Once you know that you're not wanted there and stuff, you'll have mass resignation of that group and then turn over to the next group. Sometimes things will be agreed on and whatever. But basically, that's what you're dealing with. The board mostly is not a place for disagreements between them the way that you would have in a shareholder vote, a proxy fight. So normally, that's not how it would work. And I think that's very difficult, actually. We've talked about that with some companies and things, having dissidents on the board or having the board almost half controlled by some people and half legacy people. I think that can be very tough and not a good atmosphere for making decisions because they're really collective responsibility, group decision-making for the board is how it works. So they don't want to say it, but what they need to say is, okay, half of us have to leave and half of us have to stay. Who's it going to be? Because we're totally at odds with each other, but we're half the board each, or even if it's two people on a 7-person board or something, that's going to be a problem. They're going to have votes, but they're not going to be trusted or anything else and all of that. So I think those are always difficult. But, Value Investors Club, Corner, Berkshire, Fairfax, those things would like that kind of situation because something might happen. It certainly might increase the chances that something will be sold or something like that, or that there will be a changeover. But in a sense, that's not a settled board. It's in flux between things. You're not going to stay with dissidents on it indefinitely. And sometimes I agree with them, but I don't think that them doing what they're doing is going to get results a lot of the time. So usually they own too few shares. And it would be an expensive proxy fight and stuff like that. And then once you do that, you're fighting over stuff from the past and not moving on the way that you need to be and all of that. And then you sometimes, and this is really bad, have people who are important as managers who are serving on the board or who own a lot of stock or something and are part of a group that would not want to stay in a change in control. And or even just dissidents, winning a proxy fight of some kind. And that's really bad. You can't lose those people. So I've seen companies like that where they're not a particularly honest person and stuff, but they certainly know how to run the company. And I'm not sure that I wouldn't want to invest with them because of how dishonest they are, but I also wouldn't want to invest in the company once they're thrown out because no one is left who knows how to run the business. That's pretty common with tiny companies. Not common with big companies.
Not like a lot of depth.
No, there's no one else at the company. Sometimes there's one person who runs everything, and then there's people who know how to do certain jobs, but they're certainly not managers. Yeah, they're not CEOs. So there's no one to replace them.
So what do you think the role of a CEO is?
So it depends on the company. Sometimes we're talking about really the superstar CEO thing, who's really someone who combines an owner-operator type mentality, even if they don't own a lot of the stock. That's often the situation that we're talking about. Whether there is officially chairman, lead director, whatever, they're not doing a lot of the things that people think of as sort of driving strategy and stuff like that. So that's the most common one. And although there are some that don't have a strong position because of the board things that we talked about and stuff. So they own almost no stock. They were brought in. They're professionals, and there are the people who do own a bunch of stock. That's different. At a very big company and stuff, then they bring in a professional. Over time, they're going to have a lot of control. So I think that that's the difference between a CEO and a COO, really, that we're talking about. There is all that strategic decision making of primarily capital allocation. Pretty broadly defined and stuff, doing many of the same jobs that we think of as Warren Buffett doing. But then in addition to that, they're also running a business, which is something that Buffett does not do. He does not run any of the business units. And so it's really a combination of that with the sorts of things that he does. And so when you're talking about what makes a good CEO and stuff, some of the things that you're talking about are really, a lot of it is capital allocation stuff and things like that, which is really key. And Buffett talked about that in one of his letters, I guess, where, he talked about how they have all these skills from all this other stuff they do, but until they get to the top at the company, they really haven't been taught anything about capital allocation. So it's the one thing that they may not know a lot about. And then you suddenly figure out how good they are at it or not. Mm-hmm. So,
yeah, because if they got to the top, they are, probably the charisma, and they played the game well, they played the politics well, and now they're going to allocate a bunch of capital and do a bunch of different things. And it's just a different skill set.
Yeah, it's
Buffett's
a huge issue at very big organizations. Mm-hmm. You read the book Lights Out, right? You read some books on GE. Yeah. None of that. They have no idea until it's completely different. The people who are running things inside GE are not in a position to go to be CEO of something without other people there to help them on those sorts of things. Mm-hmm. Yeah. No, because that's not the kind of thinking that organization did at the business unit level. So that's the scary thing that can happen, is they could be very good at running a business unit, but then suddenly when they're doing M&A at the top at GE, not good things are happening.
It's just interesting when you think about different CEOs, though. Like, you could think about like Steve Jobs, for example, mm-hmm. and he was very big on being very much in the creative process of the projects and the products and
very
everything
Walt
like that.
Disney.
Yeah, very much. Sort of thing. Very much. And then Tim Cook, it sounds like he is still, but he seemed more to me like a professional manager. I think he was more like operations and stuff like that. But he's also, though, done a pretty good job when it comes to capital allocation, I would say. Some people would say no, that he hasn't, and they should have bought Tesla and bought Netflix and all these other things.
Right.
But it's just interesting the different types of CEOs that people have. Because maybe Jobs was, but to me, he was very much in the creative process. And then you can look at, Mark Zuckerberg, for example. He's very much, it sounds like, there's emails that get leaked all the time of him buying Instagram. And, it was fascinating reading like his thought process to why they should purchase Instagram and all these different things like that. It's very much, it seems like capital allocation.
Yeah. And strategy, competitive strategy and stuff like that. Absolutely. Yeah. Similar to Bill Gates. Mm-hmm. Yeah. I would, the Steve Jobs thing, Steve Jobs worked as far as he was with the company, but there would have come a point that could have been an issue. So was there going to be enough room for him to do what he wanted to do indefinitely? But then he died. Walt Disney died at an early enough point also, that the company didn't expand to a size that it would have become a real problem of dealing with other sorts of things. One way or the other, they're going to have fairly low growth at some point. And so I don't know how much he would have been able to do differently. Someone was going to have to make decisions about capital allocation stuff that we're talking about. And apparently, he talked to Buffett about it. Buffett said that, yeah. Yeah, he knew he should buy back the stock, but he didn't do it.
Yeah.
So that gives you some idea of his capital allocation stuff and some of the things that could have been a problem, that he could have known, I should really do this and not do it. But he seems like the kind of person that might have happened. Yeah. It would have been hard for him to buy back stock.
Why is that? Because he just sees it as capital.
An admission that, you don't have something to do with it and you're doing this purely
transitioning into a more mature,
thing. Yeah. Mm-hmm.
Not less, you could call it like less innovative state.
Yeah, it could be. A lot of people, I think in their heart don't like the idea of buying back stock. We might not mind it as investors and things, and Buffett might not, but a lot of people don't think about it that way. Eventually, they may come around to that, seeing things from a different perspective, but that's not necessarily what a lot of people who are entrepreneurial get into something to do, is the financial engineering aspects of it. They would like to sell more every year. They would like to, employ more people. They would like to do all those things that they've thought about. And they measure it in a lot of ways besides just financial gain for people. Yeah, that's a side effect of it. And they think it will come to people who are successful in these other ways, but it's not something that they necessarily want to focus on that way. And you can see that with Buffett too. I mean, look how slow he's been to buy back his stock, for years or to, pay out capital or something like that. And that's because he really likes allocating capital himself. And so giving that away to someone else is, difficult that way. So,
do you ever see small microcaps buy back a lot of their stock? I feel like the only situations I have has typically been when somebody else either takes control or comes in. It's like an investor or a hedge fund manager. That's when they start to do all these different things.
Do the buybacks and stuff. Yeah. I've seen some, I guess, do some buybacks. I'm trying to think of ones that did very big buybacks for a long time. It seems less likely. I mean, obviously it would be harder because of liquidity purposes, certainly. But yeah, that is a hard one. I don't know how many times there have been founders and people like that who are willing to buy back their own stock. Often it's someone later on who makes that decision. Yeah.
How do you think CEOs should be compensated, especially in like microcap land? Because the problem is it's expensive to be a public company.
Yeah.
If you have overhead, you're a smaller company, so it's SG&A is usually a pretty big percentage of the cost structure, expenses. So I'm curious, when you look at a company, what are your thoughts towards that? How the CEO and key people are compensated?
I mean, you could guess that I would like low guaranteed salaries, high bonuses paid all in cash based on simple mathematical things of what targets, not what targets were hit, but, just purely on a metric, no caps on them or anything like that. The way that most companies do it, I don't like a lot of the aspects of it. They're capped, which defeats the whole purpose.
Of incentives?
Of incentives,
it reminds me of The Office when Jim he met his quota and he has whatever it is, 5 years or 5 months left. And he's like, you do realize you just removed my incentive to sell for the rest of the year, right? And they're like, yeah. And he's like, okay. He just sits around.
The company I just wrote about has a plan that basically the bonus changes in amount for people when they earn between 6 and 14% return on equity, excluding certain investment result things. So really based on the underwriting stuff. But, the difference between losing money and 6% is meaningful. And you could earn more than 14% too. So I don't know why you'd want to get rid of the incentives in each of those cases. Between a moderate level of earnings, 6 to 14% is a pretty typical sort of range that, honestly, if you just looked at all sorts of different insurance companies, that's kind of the kind of dispersion pattern you'd expect. So I don't think it's great that way to do it. Lots of them pick particular targets for certain things and add in a bunch of other targets for stuff that they want them to do. But I think tying it to some specific things is best. I think that's the best approach. A lot of the other things I don't think they need to be incentivized about. So I think it makes sense to incentivize people about stuff where it might really make a difference and not incentivize them for stuff they're going to do anyway. And I've kind of said this before with the way that we do things and stuff like that. There in investment management stuff, there's always going to be huge incentives to grow your AUM. Okay, and there's always going to be huge incentives to be seen to do well. Right. So it's not like taking only profits should be thought of as a big incentive for people to focus on outperforming others. That may be true, but you're going to find that most people wouldn't get into that kind of business to underperform other people and stuff like that and to do a job that's not that good that way. But if you change the incentives on which of a couple products you were selling, where say the company's margins are much better on one kind of product than another, then you could really tweak how someone does something. So I think that it does depend on those sorts of things. And that a bunch of times people are kind of over incentivized for certain things that they would have done anyway. So I also think the incentives sometimes make a lot more difference lower in the organization. So.
Got it. Cool. Well, I want to thank everybody so much for tuning in with the both of us here today. Go to focuscompounding.com. If you're watching right now on YouTube, you could sign up and get access to investment write-ups by Geoff. We have a free content section on this website that a lot of people like, going all the way back to 2005. All of Geoff's old write-ups. You could get them right there, www.focuscompounding.com. Thank you so much for all of the support. Make sure you hit the subscribe button, both on YouTube and the podcast side of things. If you want to get access to QuickFS, the software that we use every single day to pull financial data, go to quickfs.net and tell them during checkout that you came from Focus Compounding. Thank you so much for all the support, and we will see you in the next podcast.